How's it going, Jack?
All right, so we're recording now.
Good. Hey, Dennis.
All right, man.
Hey, Dennis.
Hi.
So welcome back. I think the breakout room process needs a little tuning, and so hopefully I'll be able to do that before the next forum. So welcome to the January forum, January 2021. Today we have this is like what, Jack, Jack's third, I think, foray into the forum presentations. He's a total pro. So we have Jack Sullivan, eminent tax attorney in New York, and Jack will be presenting to us on what we can expect in terms of the whole taxing process from the Biden administration, and an update on the payroll protection program. So, Jack, it's all yours.
Thanks, Dave. Yeah, I think this is like the second or third time I've talked about the PPP, and then obviously with Biden, there's going to be some things. Nice to see everybody. I know when I'm on other network calls, I never do the video because I can't stand it, but I have to show my face on this one. So
You do, but it's a nice face, Jack. So
you don't want to see this. You don't want to see this. No one does. I don't know how my fiance stands it every day. She's a godsend, that's for sure. So our agenda is we're going to go through the loan forgiveness basics because a lot of people are going through that process right now. Then we're going to talk about the Consolidated Appropriations Act, which gave us the new round of PPP and some other tax unique law changes in there. And then we're going to talk about possible tax law changes under the Biden administration. Anybody who knows me knows I never like to talk about possible changes. Changes are going to happen, and right now is a good time to talk about the possibility so you can start thinking about what may happen because of what happened down in Georgia, regardless of your political affiliation, tax laws are going to change because the Senate's 50-50 with the tiebreaker at the vice presidency now. So something is going to happen. We don't know how severe it's going to be. So that's why I felt comfortable talking about that. If Georgia went the other way, I wouldn't probably have been as concerned to talk about this. But now that Georgia went that way, you have 50-50 Senate, you will see tax law changes. There's no doubt about it. To what severity, we don't know. So let's talk about the forgiveness basics for the PPP loan for those who got it or they have clients who've got it. Basically, the form, if you don't know and you haven't done it already, is the form 3508. That's the basic form. And that means you have to complete that to get some type of loan forgiveness, okay? There are three versions of it. There's the 3508, the 3508EZ, and the 08S, okay? Now, to get forgiveness, the rules evolved as we know over time, and the only reason everyone knows is usually when I'm talking on these things, not everyone knows, but because we're all stuck in front of our homes looking at TV, probably everyone knows that the first round of PPP, you had to have 80% for payroll, then it evolved to 60%. So you had to use it for eligible expenses, 60% of the loan for the payroll cost, 40% for either mortgage, interest, rent, or utility. You had to basically keep your full-time equivalent employees up and not reduce employee wages by more than 25. Now, the basics of the three forms, the 3508 is by far the more complicated form. That's the one you use if you've got a considerable forgivable loan from the SBA and your bank. This form is 5 pages. It's very complicated. By the way, I'm not going to go into the nuances of these forms, just giving you kind of basics. So if you haven't applied, you kind of know which bucket you'll fall into. The 3508 is the one you don't want to have to fill out. It's very complicated. If you're forced to fill it out, your bank will guide you in a direction of what you have to fill out based upon how much you took out and how complicated your business is. If you have to do the 3508, I definitely recommend you get an advisor involved. It's not a simple form in any form or fashion.
Hey, Jack.
Yeah.
Can I just ask real quick? So when you talk about the smaller loans, like, is there a threshold that if your loan is below a certain point that it's automatic or easier or anything?
What I was thinking, Lance, and that was Lance, if it's okay with everybody, because of the way we're doing this, can we hold the questions till the end? Because then I won't, because I'm going to cover that, Lance. That's the only reason. I'm not talking. Okay. I'm going to get there. So let me do the presentation, and then I know there's a room and Sean's on. There's a room that sets up all the questions, and sometimes I can't see it. I did a presentation yesterday, and maybe Dave can then read the questions to me. And then if it's not covered, we can have people then chime in afterwards. Does that work for you, Dave?
Sure.
I'm sorry, Jack.
No,
Please forgive
no
me.
problem, Lance. No problem at all. I just want to let you know I kind of saw that coming, of course.
Okay.
Yeah, no, no, thanks for the question, though, but I just think it's a better way to do it because we're all doing Zoom. We're
Okay,
in the
thank
room
you.
together. I like the questions, but here it doesn't really work.
Okay.
So now we have the 3508EZ, which oddly is not the easiest form. So whoever designed this, I don't know why. Basically, use the EZ if you meet one of the following requirements: self-employed or have no employees, have employees but didn't reduce their wages by more than 25% and did not cut employees' hours, or have employees but did not reduce wages by more than 25% and couldn't operate as normal due to COVID-19. You have to calculate payroll costs. It's not as complicated as the 3508, but there is a calculation aspect to it. So again, when you go to the portal, you're going to see that most likely your bank is pre-guiding you in a direction. Now, right now, most banks, including Chase, the bank that I deal with for a lot of my clients, the 3508 and the EZ are up. However, what's not up, and this goes to your question, Lance, is the 35OS, which a lot of smaller clients are using, and that's the 50,000 or under. And that's the really easy form, where you just basically certify, I took the loan, I obeyed the rules, and you sign off. And that's the easy. So if you're under 50,000 or less, that's where you have to go. Most of my clients are falling in the, from what I'm seeing, in the 300 to 150 range. That's what a lot of my clients are finding. The ones under the 50,000 are waiting for their banks right now. But most of my clients are in that range. So to your question, Lance, most likely a lot of businesses are going to be using the EZ form. I have a few that are using the 3508, and I'm working with them on that. It's a bit complicated. It's a pain in the neck. And I actually have spreadsheets that I work with to try and do that. But the 35OS is a much easier form. So if you're a solopreneur or have a small business and you're under 50,000, use the 3508S. I don't know if it's available for your bank. Every bank is different. But don't do the EZ form if you can use the S form. Trust me, don't be tempted. There's no rush to the altar here to get forgiveness. I suggest, because everyone's running their business, it's the new year right now. We're still in COVID. Don't take the time doing this. We're on the network. Do what you're good at, not what you're not good at, and wait till the 08S comes out if you can utilize that form. Just so you know, this is kind of the documentation requirements you're going to need. The application, you're going to need bank account statements, payroll, federal and state and local filings, health insurance, mortgage interest payments, rent or lease, utility payments. A lot of the things that you need when you originally applied for the PPP back in March or April, you'll now need those most likely again for the forgiveness process. Okay? Now we're going to talk about the CAA, which is the act that just passed that's going to, that basically re-up some of the CARES provision, of the CARES Act. We're going to touch on a few of the tax provisions of the act and then the PPP aspects of the CAA, because there were some tax provisions. And we're only going to touch on a few of them. I don't want you to sit here and say, oh, you didn't touch on this or not that. But because of the form we're in here, no pun intended, I'm just going to touch on a few of the ones that I think are relevant to what we're talking about here. And then we'll talk about the PPP aspects. The biggest thing, which I touched upon a while ago in this group and other groups I'm involved with and other groups I've spoken in front of, is now the expenses related to PPP loan forgiveness are now deductible. They were previously not. So as we know, the original CARES Act included a loan forgiveness program under the PPP, right? So any forgiven loan that's used for payroll costs or certain other expenses. Under the CARES Act, forgiveness of the loan does not give rise to taxable cancellation of debt income. Normally, you get a loan from a bank, right? Bank forgives a loan, $50,000. That's $50,000 to you. That's the way it normally works. CARES Act said, no, we're going to forgive the loan, so you're not overburdened with all this stuff. Great. But the IRS said if you paid for expenses with the loan that's forgiven, then those expenses are not deductible on your tax return. When they passed the original CARES Act, they did not put that in that act. That was a mistake by Congress. It was an oversight because they were trying to rush to get it done. I don't fault Congress for that. So the IRS had to come out with rules. And they said, no, under our rules, forgiveness of debt, income, not put on your income, then you can't take the deduction for the expenses. The CAA reverses this rule. And now you get a $50,000 loan, you get it forgiven. Those expenses are now deductible. And that's a big thing because a lot of people, my friends, clients were coming and they're like, wait, I had a $300,000 loan. Net, now I have $300,000 less in expenses. So really, I have an increase in my income, which was true. This now gets rid of that. Also, one thing that's in here, too, that's important is speak to your accountants because there are things about having loans on your books that also affect the basis of your entity. And you don't lose those tax aspects of your loan, of your basis and your loan basis, even though these are forgiven loans. This is a complicated area that's beyond what we're talking about here. But definitely reach out to your CPA. So more or less, if you get a $50,000 loan, arguably the basis you own in your entity now is still increased by $50,000, even though you never repaid it back. That was a big sticking point in both the CARES Act and the CAA, and that has remained. So in other words, you're getting arguably $50,000 a basis in your entity, even though you never had to repay the loan, and you get the tax deduction for the expenses. Kind of a gift, actually, to small business owners. Okay? Now, here's some additional thing. You have the employee retention credit. That now goes to $70,000 of qualified wages, and that cap on that credit increased to $28,000. That's a change from the CARES Act. It was originally only $50,000. First, and also the employee retention tax credit can be used to offset all federal payroll taxes, including withholding tax and employee share of Social Security tax and Medicare, but not the FUTA, which is the federal unemployment tax. That's on your 940 filing. That's a small amount. It's inconsequential. The taxes on your 941 filings are not inconsequential, especially on the employer match side, as everyone knows who owns their own business. So this credit now can be offset. Okay? And PPP borrowers now can get that retention tax credit, which they originally could not get. I won't get into the weeds on that, but previously you couldn't get that credit. Now you can get that credit, even if you have the PPP, but you can't double dip and get both. But previously, if you had one, you could not get the other. So this is a nice thing, and it goes back retroactively to the effective date of the CARES Act. Now, this is the 3 Martini lunch. I sent out a newsletter, I guess, about a month ago when they were talking about this. Somehow this got through. I'm sure there were no business owners complaining. As you all know, basically meals and entertainment was 50% deductible on your tax return up until the TCJA of 2017. That then removed the deductibility of the entertainment, right? So then you only had a tax deduction on your tax return for 50% of meals. Well, this was an add-on in the CAA. Now you go back to the old 80s aspect of the 3 Martini lunch, now 100%. So you take a client out, you spend $200 on lunch. It used to be only $100 tax deductible. Now it's fully $200 to tax deductible. This is only available for probably 2 years, 21 and 22. I think they'll try and reverse this as quick as they can. So enjoy it while you can. But this is something that will definitely last through at least 21. I don't think he'll retroactively get rid of this. It may not survive 22, but it will stay around on 21. So once the COVID ends, go crazy, as they said. And this is the last one I think we'll touch on before we go to PPP round 2. Basically, this is a deferral of the employee side payroll taxes. This basically extended the deferral, only was going through April 30th, 2021. Now it goes to the repayment period to December 31st, 2021. If you're taking advantage of this, this is arguably the first time the 941 payroll tax return will have probably changed on 10 or 15 years. And if any payroll people are on here or any bookkeeper folks, they could correct me on that. But that 941 form has stayed the same for years. If you're taking advantage of this provision, make sure you're talking to your payroll provider and working with them to make sure this is not screwed up. And just because you're using ADP or Paychex, don't think just because they're a big company, they're going to do it right. actually, they're the ones I worry about more. The larger payroll companies are the ones that I work with more on when they screw up for my clients than the larger ones. I mean, than the smaller ones, because I can usually work with the smaller ones and they want to get it right to keep their clients. Paychex and ADP generally doesn't care because they're the elephants in the room. So if you're going to think about using this, make sure you hold their hand and make sure you get your CPA, your advisor involved to make sure this is being done properly. So this is now the PPP 2.0. There's an additional $284 billion in loans available, and the same criteria are going to be used here, except it extends what expenses are forgivable. Okay. Generally, we know before 60% has to be used for payroll. Okay, but now you have covered operations expenditures. So that expands beyond rent, mortgage, and utilities. Payment for business software, cloud computing goes in there for business operations, product or service delivery, property damage costs, then the catch-all supplier costs. Any expenditure for goods that are essential to the operations made pursuant to a contract order or purchase order. That kind of, almost in my opinion, covers a lot of different things. There's not any guidance on this, obviously, as we know this, I believe, was signed on December 28th. So that's kind of a catch-all that covered supplier costs. And then worker protection expenditures means any operating or capital expenditure to facilitate the adaptation of a business of an entity comply with health and safety standards on or after March 2020. This is PPE, house screening, et cetera, et cetera. What it doesn't cover is expenditures on residential real property and intangible property, specifically not eligible for worker protection. In addition, with regards to the payroll costs, which you have to once again go with at least 60% to get for forgiveness, now you have benefit costs that have expanded to employer paid group life, disability, vision, and dental insurance. And that was not previously in the first round. Okay. SBA opened the first draw loans. That means for someone who didn't get a loan the first time this week, arguably January 11th. That was more for community lenders and lenders in underprivileged areas and things like that. That was specifically put in the law. The first draw PPP loans are made to eligible lenders. They qualify for forgiveness for the same 18 to 24 week cover period, right? And you have to keep your employee and compensation levels, have to be spent on payroll, other eligible costs we just talked about. And again, you have to keep that 60% of proceeds on payroll. Who can apply for the first draw? Eligible small entities together with their affiliates having 500 or fewer employees, including not-for-profits, veteran organizations, tribal, self-employed, sole proprietors, independent contractors. And entities with more than 500 employees can get in, but they have to go through an SBA exemption process. And you can apply for this SBA loan up through the first draw of the second round through March 31st, 2021, through basically any organization the SBA approves. Now for the second draw, basically the terms are more or less the same with a few differences, okay? Supposedly it opens today, January 13th. Most banks that I have talked to, the portal hopefully will be open next week. I believe Chase has told me that. I'll believe it when I see it. But the bankers I've spoken to Chase are thinking next week, sometime probably mid next week. Again, same thing, 8 to 24 week, maintain the levels and the pay, and use the proceeds for the proper expenses and 60% as well. The only difference here is 300 employees or less, and you have to show a 25% reduction in gross receipts between comparable quarters in 2019 and 20. So what I suggest is you do an analysis between quarter by quarter revenue, which I've done for some clients who've sent me their bank statements, to see if you had a 25% reduction in any quarter. This was done because there was a great deal of fraud in the first round, as we could all have anticipated as Americans. If they're giving away money, we know there are going to be people who are fraudulent running to the trough. So basically there was a lot of fraud. Now they're saying up front, you have to have a 25% reduction in some quarter from 19 to 20. Otherwise, you are not going to qualify. Then the question becomes, okay, well, how are they going to document that? And that's a question I'll talk about in a minute. But just know up front, you've got to be able to show, and I believe the banks are probably going to ask for this, but it's not clear yet, that you have some type of reduction, a 25% reduction or more. Okay? And basically the maximum amount, here's a nuanced change too, as same as before, is 2.5 times the payroll we had from the same time, and it goes up to 2 million. However, if you're in accommodation and food services, obviously hotel, lodging, and restaurants, that can go up to 3.5 times, which I think is a welcome change because we know hospitality is getting crushed. I do think certain other industries should have been thrown in, but at least they threw a bone here. Same rules apply March 31st for basically any banking or other industry that deals with the SBA. And again, this loan is issued by the bank, not by the SBA. I'm not getting into the EIDL loan here. There is additional monies for the EIDL loan. If you've not applied for one, then I suggest that you go down that route because I know more money was made available. That loan is applied through the SBA and not your bank. But if you're going to apply for first or second draw loans on the PPP, you go directly to your bank. One nuance here, and I was reading an article on my way in this morning that could open things up to fraud, is they're going to simplify the loan relief process right here, the forgiveness process, and say under $150,000, supposedly the loan forgiveness is going to be very, very simple. So then the question is, how are they going to make the fraud not happen on the front end? Because when you applied the first time around, there was a lot of fraud, as we see. Well, people are saying maybe possibly 80 to 100 billion, maybe more fraud, which is horrible because basically they were accepting PDFs and everything else. We know people were doing doctored things and sending it in. Now I think the banks are going to be a bit more stringent about the application up front, hopefully. And then the back end forgiveness will be a lot easier. So if you get $150,000 or less, you just file a certification. Just so you know, if you go down the road, I don't suggest it a fraud, you can get brought in by the federal government, the IRS, the SBA, or your banks. You have 4 entities that could be looking at you. So I suggest it. But I think the application is going to be a little tougher this time, but the forgiveness is going to be a little bit easier. So to Lance's question, if you go and you go this time for a second draw, if you're under 150 grand or not, there should be a very easy forgiveness application process.
Thank you.
Okay, now we're going to switch gears. Possible tax law changes under a Biden administration. As I said in the beginning, I never like to talk about things that could happen. However, some of this is going to happen because, again, now you have a Democratic Senate and a Democratic House of Representatives. So some of these things are going to happen. So just kind of put it on your radar and think about it for this year. And probably I have to think that we'll probably know something within the first few months of what's going to happen from a tax perspective. First thing I do think will probably happen is an increase in the personal income tax rate. Go back up to the old Bill Clinton, 39.6. The TCJA lowered the rate to 37% for 18 to 25. I do think that will change and it will supersede the act. Also, Biden is saying, as we all heard, because we were at home watching the presidential race occur, if you're over $400,000, that's where the rates are going to change. And he's also talking about changing Social Security. So right now, if you're at 142,800, you top out. There's no more Social Security taken out of your paycheck, nor are you paying the employer side if you run your own business. Now from 143 up to 400, if Biden gets his way, there'll be no increase in Social Security tax. However, you'll restart over $400,000. I've never seen this before. I don't think it's the worst idea right now with everything that's going on around us because of the budget holes we've got. Some people don't agree, which I completely understand as well. But that is something he's been talking about for a while. I've never seen it done. I think it will be a highly litigated matter on the House and Senate floor. I don't know if he'll get that done. But that is something that will affect people significantly because those are not small dollars, obviously, as we know. Corporate tax rate, I do think that will probably get done. As we know, it was 35, then went down to 21. Now it's going to go back up to 28. I do think that will happen. I don't think people are going to be crying. You're going to have some moderate Republicans that'll be like, all right, we got to do something because the deficit. And I don't think it's a crushing blow to bring it to 28%. I liked it going down to 21. I think something had to be done. I thought 21 maybe a bit drastic. I don't think 28 is a backbreaker. I think it's a good idea. What is interesting, though, is he's talking about reinstituting the corporate AMT. For those who are not tax geeks, the AMT is the alternative minimum tax, which is a separate taxing system that the Trump cuts got rid of. He's now thinking of bringing it back, saying basically, when you file your financials, I'm going to look at the book income, not the tax income. Because book and tax income are different things, because everything for book income that are accepted for what's called GAAP purposes is not true for taxable income when you do your tax return. He's saying, no, I want to apply a 15% tax rate on your book income when you file your financial statements if you have 100 million or more of book income. So if a company's got 100 million or more of book income, considering everything that's going around right now with the deficits, maybe it's not the worst idea for them to contribute a little bit. You may not agree with me, that's fine. But that's what he's talking about. I don't know if that will pass, but that is something that he is talking about. But I do think the corporate rate will pass. I will be shocked if that's a big thing. Maybe they'll say not 28 or 25. But I do believe that will pass. The itemized deductions will now be limited. He's going to limit the itemized deduction to 28% for upper income tax individuals. This happened under Clinton, then slowly was removed from Bush to Obama and then to Trump. It was fully removed. So basically, you're not getting your full amount. If you're 39.6%, you're not getting it. You're getting it limited. He's going to go back to the pre-Trump rule levels. And the other thing he's going to do now, which is a throw out to the blue states, is he's going to try and get rid of the SALT cap. I don't know if that will fly because I think you're talking out of both sides of your mouth if you're limiting the itemized deduction on one side, but yet giving a throw out to the blue states on getting rid of the SALT cap. As a New York City resident who owns his own place, I'm in favor of this selfishly, but I do understand from a deficit perspective, this may be hypocritical, and he may not win on this. I can't anticipate how it will go, and I think this is going to be something that's going to be argued. Because you read all these articles and they say it is hypocritical to say you want to raise taxes, but yet not this one thing. I want to have the tax giveaway to the upper middle class in the blue states. So that's going to be an interesting thing that's going to be ferreted out over the next few months. Capital gains increase. For those who are investors out there, we've had it pretty good for a while. I'm an investor as well. Now, what he's going to do is try and get rid of the favorable rates and basically said, if you're over $1 million, I'm going to ordinary income rates of 39.6% for long-term capital gains and dividends. That's what he's thinking to do. Now, if you go to the Obama net investment income tax add on of 3.8%, arguably now you're looking at a 43.4% tax rate on capital gains if you're making over $1 million a year. I'll leave it to you how you feel about that, considering everything that's going around. But that is basically almost a doubling of that rate, which is quite considerable. I know that Warren Buffett once said, I never look at the tax rates when I make my investments. So we'll see if that affects the capital markets. But I think this is 60% chance of passing, but I don't think he'll get the full amount he wants. I think it'll be somewhere in between the 39.6% rate. I think they'll come up with a hybrid rate. I think they can argue it's too extreme. We'll see what happens. Now on the estate and trust tax world, this is a huge thing. I'm not an E&T lawyer for those that know me. This is a massive thing they're talking about. They're trying to getting rid of step-up basis for inherited assets. So basically under current law, the federal income tax basis of an inherited capital gain asset is stepped up fair market value as the decedent's date of death. So something was originally the basis was $100 in, let's say, old A&T stock that your grandmother had, and she perishes today, and that stock now is worth $1 million. Under the old rules, the date of death, the basis in the stock went from $100 to $1 million on date of death. So if you sold it tomorrow for $1 million, you paid $10. You paid only on the capital gain of $10. What Biden wants to do is get rid of that and say, no, you keep the original basis of $10. You sell it today at $1,010,000. your the tax capital gain rate, you're going to pay $1 million times the capital gain. That's a gigantic change. Gigantic. This is going to be a really big, hard thing for him to get done. I think he's going to have a real big problem with it. I understand the logic behind it. I don't know how I feel about it. I think it's a massive change in the way things have operated in this country. But depending on how you feel, how you transfer wealth in this country, this has been something that they've talked about for decades. He's going to try and get it done. I don't think he will, to be honest with you. I think it's too drastic. But the trade-off is the flip side. If he doesn't get that done, then what he's going to try and do, which has never happened, is he's going to try and reduce the federal estate tax exemption. I have friends who are E&T lawyers, and from what they tell me, and if there's one on the phone here, correct me if I'm wrong, but that exemption's never gone down. It only goes up. It'll plateau for a while, but it's never gone backwards. He wants to bring it back to the 2009 levels for $3.5 million estate and the $1 million gift. And he also wants to increase the rate to 45%. This will keep E&T lawyers busy for all of 2021. This is going to be, again, with what we talked about for the step-up basis and the decrease in the exemption are going to be highly debated on the floor of both the House and the Senate. And I don't know which way it's going to go. I don't know if he's going to get a reduction, but something's going to happen with one of these two things. Again, only because of the pandemic-induced increased deficit. I think something's going to have to happen because the Democrats control both sides and the presidency. I think something will happen here. Here's something interesting, and we're almost at the end, folks, that I find fascinating. I give a lot of speeches on the Trump tax cuts, and one of the interesting things in the Trump tax cuts was the 199A deduction. And in that, the Trump tax cuts had specific things in there that he disallowed certain industries, almost as if the president didn't like certain industries and he did certain things. This seems like retribution for that. So there's going to be an elimination of real estate tax breaks. Now, why would that be? Because the current president is a real estate tax person. So what he's looking to do, I don't know if this will work because the real estate lobby in America and in this city as well, as we know, and all over the country is severely strong. He's looking to get rid of the $25,000 exemption for passive loss rules for rental real estate losses by middle income tax individuals. That's a big thing. But the next one is the biggest thing. The elimination of the 1031 like-kind exchange that allows the deferral of capital gain taxes on swaps of appreciated real property. Now, I don't know if anybody on here knows what that means, but that means if I have rental real estate or commercial real property, and I want to get another piece of property, what I do, if I want to, but I don't want to pay tax, is I swap my property for another property through a very complicated process. And there are companies that do these 1031 exchanges. And if you do it right, you kind of sell your building to another guy and you get his building, but yet you pay no taxes. But if you think about it, what really happened is you sold the building, kept the money, bought another building, and yet you never paid tax on the first sale. My old firm did a lot of these things, and they used to call it legalized theft. You don't have to agree with it, but these guys were the biggest 1031 exchange guys in the city. And they used to joke around. We know this is going to go away. I've never heard of anybody talk about it until Biden. And Biden is thinking of getting this away. This is a massive thing in the real estate world. Hotels do it all the time. Everyone in this city does it all the time. My real estate friends say this is a massive thing. I don't know if he can get this done. It's in here. He's talked about it. Most people don't understand what it is. So it could be one of those things he can get by because it won't get a lot of publicity, but this is a gigantic thing. He's also going to get rid of depreciation write-offs for certain real property. I don't know if I agree with the removal of that. I do think that allows people to invest in their business. I don't think that's a good idea. I don't know if he's going to get that by. Like the 179 deductions and special depreciation deductions that have been around for a while. I think he's going to have a hybrid. He won't get it all done. And then, again, as a payback, he's adding in a cutout for an industry he doesn't want. And he's saying you're going to eliminate the qualified business income, the 199A deduction for profitable rental real estate activities. If you remember, when he did the 199A deduction a few years ago, this originally, no one knew if that was going to remain because of a lot of high net worth individuals who were senators and congressmen at the time on both sides. They're like, Democrats and Republicans are like, no. Real estate has to not have a floor on this, a ceiling on this 199A deduction. He's saying here that if it's profitable, you don't get any of that 199 deduction. That's going to be a big deal too. So those two bolded areas, I think, are going to be highly discussed on the House floor and the Senate floor. Good thing here for everyone that will like, child and dependent care credits are going to go up. One of the things I loved about the TCJA and Trump was these credits that were actually real credits. Usually for everyone on the phone here, you know that credits don't usually work. If you make over, let's say, $100,000, you don't get it because they got rid of the dependent exemptions. Now that credit went to $2,000. Now they're raising it up to arguably $4,000 to $8,000. And if you make $125 to $400, you would still receive the credits, although they would be reduced. Also, you're going to get a $5,000 possible new credit. Hopefully, will be refundable for informal caregivers, which I think is great as well. I think this is one that people on both sides of the aisle can agree on. Also, I like this as well. I think this is something that could probably fly on both sides. A new refundable tax credit for up to $15,000 for eligible first-time buyers. This credit's been floating around here and there for 20 years, and for both Republican and Democratic sides. I think this could get bipartisan support. I'm not sure how this refundable tax credit for low-income renters will work. I haven't seen a lot about it, but I wanted to put it in here. There's been talk about how renters in this country have always gotten the short end of the stick. I'm not sure quite how this could happen. It just says the credit will be intended to hold rent and utility payments to 30% of monthly income. That seems awfully complicated and also quite invasive. I don't know how that will get done. I think people will cry the old socialism word for that. And I don't think that one will fly, but I don't know. We'll see what happens.
It sounds like a double dip.
Yeah, it does. It does, Dave. And that's the one I don't think will work. And I don't think it'll work, but I don't see it happening. But I could be wrong. But that one seems very invasive into a capitalist country, telling people really how the renting in this country works. So we'll see what happens. And I'm almost done here, I think. Last slide. Green energy tax changes. I'm a green energy guy. Basically, he's going to expand some tax incentives to reduce carbon emissions. If you're not a fan of this, I understand. But it looks like he's going to try and make it a little bit better for people to invest in green energy. One thing that he's going to get rid of, which I actually know a lot of, he's going to try and get rid of, is oil and gas drilling costs and depletion. For those that don't know me well, I went to law school in Pittsburgh, which used to have quite a drilling area before they went to fracking. And depletion is kind of depreciation on oil and gas wells. And that little tax deduction has been a huge boon for oil and gas drillers in this country since the 80s. He's trying to get rid of that. I don't think that's going to go away easily. Don't think that little sentence doesn't mean something. That's going to be a big deal. Depletion basically is depreciation when you're digging a well, and then you get to depreciate the cost over a period of time for the drilling of the well. That is not a small amount. If you're ExxonMobil, you're Hess, your Chevron, if they even exist, I don't know who exists anymore. That is a big deal. So that's going to be interesting to see if that thing gets swept under the rug. Personally, I think it's high time we get rid of it, but I don't know what's going to happen. I'm not a big fan of the oil companies anymore. I think they've made enough money. That's just me saying. But that's going to be interesting to see. So if you hear about depletion, you heard it from me first. That's going to be something that I think is going to be negotiated, or they're just going to say, we're not doing it, Joe. Don't even bring it up. Well, I think what will happen possibly is they'll give him some of the green energy stuff he wants, but depletion will remain, and it'll never even hit the national media. And I think that's it.
Jack, that was great. If you drop this off the screen, I'll be able to see people, so we'll be able to call on people as well. And
Okay.
you can call them as well.
How do I do it? Am I good?
I'll do it.
Okay. Sorry, I'm a spaz. I'm like those old men on the commercial. So
Hang on, let me see if I can do this here. Share screen.
So Jack,
Yeah.
Okay.
on a
Yes.
1031 exchange, is the cost basis the original piece of property, or does the cost basis adjust to the second piece that you're trading up for?
You're asking the wrong guy.
Okay.
And I don't mean that in a bad way. 1031s are a very complicated, nuanced area of the law.
Yes, they are.
And they are companies that all they do is
It's a whole industry.
Yeah, it's a whole industry. Doug Wasser, who I share office space with down here, knows a lot more about it than I do. But 1031 is its own area. If you're in a situation where you have friends or clients or you yourself, or let's say you have a piece of property that you rent out residentially, that qualifies for 1031 exchange. If you have any of this, call your CPA or your lawyer today, because that, I think, may have a real chance of passing. People have told me for 20 years, they don't know how it still exists. So if you've got that, I'd make a phone call, because that, I think, will change. Maybe I'm wrong, but I don't think you want to, you really want to work on, you really want to look into that. I don't have the answers on the 1031. I just wanted to point it out so you're aware of it.
Okay.
You make that phone call when I stop talking with my raspy voice here. Anyone else?
Yeah, that was great. That was great, Jack. But, you know, the one thing you didn't even mention is the PPP round 3, because you know there's going to be another huge stimulus being passed. I'm being joking,
Right.
but we're going to have another stimulus come out that's going to be bigger than anything we've seen. So
I agree with you.
So throwing all this crap on top of this crap, there's a lot of stuff going on.
No, there is. And again, I didn't want to touch on the third round, if you will.
Yeah, I hear you.
It's going to be packed with so much stuff. And right now, the ability of what's going to get in there has changed, right, Steve? The dynamics changed. Because before, you had the Senate Republicans stymieing the House. Now you have a majority Democrat Senate. So there's going to be more. You're going to have probably that $2,000 stimulus will come through. But there's always going to be a give back because you have some conservative Democrats. So I didn't want to get into round 3 because round 2 isn't even out yet. But no, Perk, you're right. Without a doubt, there's going to be a third round. And that will happen probably within a month. And once that happens, I'll either send out a newsletter or Dave will have someone talk about it. But that is going to happen, I think, within a month. Yes, I agree.
Jack, if I might,
Yes,
let me
Mike.
ask you about tax implications on forgiveness. So on the PPP, on the first go around, there's forgiveness. Is that counted as income on the federal side? Is that counted as income on the state side?
It's not federal. The states, I've not seen what the states are doing yet, in the sense, I don't know if they've fully made their decision. My feeling is some states are going to force an add back and some states won't. What Mike's asking is, when you do your federal tax return, the income number works off the federal number first. And then there are add backs if you look at your tax returns for the business owners on here. There are add backs, depreciation add backs, various things like that, state and local tax add backs, right, Mike? Here, this could be that cancellation of debt income add back saying, hey, Mike, your business got a $30,000 loan forgiveness, the COD income. Congratulations. We're the state of New York. We don't care. That's $30,000 to you to income. And that's not an inconsequential question. Because my feeling is because of Cuomo and the deficits we've got in the state, as all over the country, I think it's a real possibility Cuomo will add it back. I've not seen anything come out formally yet. But once I know about it, I'll let everyone know.
Can I ask something about the PPP?
Sure.
I did not apply last year.
Okay.
I probably could meet the test where 1 quarter of 2020 was less than 1 quarter of 2019. Not on all 4 quarters.
No, just 1 quarter.
Right.
And because you didn't take the first one, you don't have to worry about that, just so you know. It's only the second draw.
My question as a self-employed LLC, I have no employees. Would I be able to meet the requirements if 0% goes to payroll, or could I hire a part-time person now so that some payroll exists?
Well,
Or
you take
there's no way to get around
You
it?
pay yourself.
you take a draw, by the way, to pay yourself, correct?
I don't now. I just live on commission and save money between commissions. But if I set it up that I have a level payment, then would I meet the law of the PPP?
Right. Well, the PPP for people like yourself, if you have a single member LLC, first off, LLCs can't pay payroll anyway. You can't do that. You pay yourself a draw under federal law. So,
Okay.
but that's a profit issue for an LLC. And we could talk more about it because that's something I covered in prior PPP discussions. but you should be able to get it long as arguably the entity was profitable with some exceptions. So you'd want to reach out to your CPA to see. I've had people ask this question because there is a calculation that an LLC has to do to come up what that amount of the loan they can get. And this first round for you, first draw, second round, you don't have to worry about that reduction stuff. That's only for people taking the money the second time, right? So a lot of my clients are getting another loan. You're getting your first loan. So you're going to be under the criteria of the first loan just for this time around. So I would reach out to your bank and your CPA and see what they need from you to file it. You'll need tax returns and things like that, kind of on that, what I sent over to you before, but you will need all that information. And that generally, from what I recall, works off a profit. I haven't done those calculations in a while in the world. There's been 10 years in 1 year. But definitely reach out to your CPA, your bank, and if not, you can contact me.
Okay, thank you.
Any more questions?
Anyone else? No Irish coffee in the morning like me? No? Nobody?
Jack, that was a great show. Thank you very much. You always have a lot of great information. So thanks again.
Yeah, that was great,
You will
Jack.
be making those slides available to us?
Dave, it's up to you. What do you want to do? I could send them.
I've recorded this.
Yeah, I like the recording more because I always worry people make tax decisions based on my slides. I do know everybody on here though. Dave, it's up to you. I can send it to Dave.
Yeah, so I've recorded this, so I'm assuming that the slides will be in the recording, no?
They should be, yeah. They should be.
So I'm gonna post it. I'll post it on the website, so you should be able to just pick it right off.
Okay, great.
Let me mention that my wife and I used Jack's services several years ago on some tax matters, and he was very helpful. So if you haven't worked with Jack, you should feel free to do so, folks.
Thank you very much, Mr. Grant. Long time. How you been?
Just fine, Jack. Yourself?
Thanks, David. Thank you. Great.
So you know the mantra. I think it might be Lyle Katz's mantra. The only mortgage banker you ever need. So Jack is the only tax lawyer you will ever need.
Well, thank you very much. I appreciate it.
And I truly believe that. And so at any rate, that was great, Jack. I really, I thought you did a great job as always. That was never going to be in question, and extremely informative, very powerful. I think everybody really appreciates the all the information that you gave, and thank you. So.
Thanks, Jack, especially the commentary behind the rulings. Always interesting to get your
Take
personal opinion on these issues.
Yeah,
Thanks so much, Fred. I
absolutely,
appreciate it.
absolutely, Fred. I totally agree with that. It's so it was great, and so we'll have I'll keep this open as long as people want to stay. I'm not going to reopen the breakout rooms, but so you can stay and chat, and if any questions arise that if Jack is still on, you can certainly ask him. And with that,
So Jack, maybe if you could, I know this might be a bit of a burden, but if you could break that presentation into two, the PPP stuff separate from the tax, it might be helpful for those of us who are interested in the PPP, and we could avoid, any conflict in terms of the opinions about taxes, et cetera. Because the stuff on the PPP, you had no opinions; it was just fact.
Right. Yeah. Okay. I can do that, Dave. And by the way, the only reason I did that, Mike, this way, normally I don't do these hybrids, was because this is where we're living, and I know what would happen at the end. And we're like, well, what about Biden? So I knew that would happen.
I think that's great, but just for the sake, PPP versus tax would be great. That's why I would love to see the slides, and I understand the recording. Problem with the recording is that we're going to be listening to the whole thing, so on and so forth. Also, it's big files, Dave. I've done the recording.
so the first,
Dave, if you send me the listing of everyone who was on here, took the time, which I appreciate, by the way, I'll cut it and I'll send everyone the PPP stuff. No problem
Okay.
at all.
I
I'll
can do
send
that.
it a PDF.
Thank you.
Thanks. Great. All right. Thanks, guys. If you need me, you know where to reach me, and I appreciate it. Thanks so much, and stay safe, everyone.
Bye-bye, Jack. Good to
Excellent.
see
You
you.
take care.
First time I've actually seen you. Good to see
I know
you.
it's been a while.
You look
Hey,
great.
you know what? I really missed your tax stories about why you should pay your taxes. I mean, of course, everyone does, but because they'll come and get you.
Jack, before you
Hopefully,
go,
maybe by
Maybe.
June we'll be in person. Hopefully, right?
Jack, before you go, also take a look at the chat because a number of people sent direct notes to you.
Well-
They were sent to everybody, but they say thank you, Jack. So you know,
Okay. Great. I will. Great. Thanks so much, guys.
Everybody. Bye, Dave. Thank you.
Bye-bye, guys.
Bye-bye. Bye-bye, everybody.
See ya.
Take care, Dave,
Take care. Bye-bye.
Jack, everybody.